morning, everyone. It's fun to be here. I sat down to make my talk yesterday. You'd think maybe we were more organized than that, but we aren't. Eric and I often email each other at like 11 p.m. the night before being like, have you started yet? But I actually sent my talk to Matt at like 4 p.m. yesterday, so very organized. One of the reasons I was very organized was because there wasn't a huge amount new to say, and I sort of say that almost defending myself before I get started here. I looked at the talk that I gave back in September at the Metals Investor Forum, and then I looked at the talk that I gave a few weeks ago down in New Orleans at the Gold Investment Conference down there. And gold has been boring and a little bit seasonally disappointing since then, but the fundamentals haven't changed, and so there wasn't a huge amount new to insert into the talk. So that's almost the point of what I have to say today, is that things haven't changed that much. There is some seasonal things to pay attention to at this point, but at the end of the day, the fundamentals are what they are, and so it's still sort of steady as she goes. I think this is the summary of what I'll talk about for the first few minutes here. Which are those fundamental reasons? This is the macro position that we're in right now. And it is stronger for gold than it has been for a long time. In that sense, it's the most exciting time for gold that it's been in a while. Of course, the overhang of the fact that gold is off in the last few weeks, dampens our enthusiasm a bit. But it shouldn't, because at the end of the day, the fundamentals are stronger than they have been since this bull market started, however you want to define that. And that's led off absolutely by real rates, which are now negative in the United States, and the United States therefore is joining a cadre of countries where we have negative real rates. Negative real rates are the fundamental bullish force for gold. And then we have all the other things that layer on top of that, the bond market, a bunch of uncertainty, central banks that are buying gold, currency competition, that's all part of the trade war. So let me just talk about each of those a little bit. The chart here of the price of gold going back a bunch of, 50 years, shows that gold is pretty good at gaining. Gold, of course, does not just gain 4.5% every year. Gold gains in spurts and then loses for several years in a row. But there's a really clear indicator of which direction or how any particular year is going to play out, and that is what is going on with real interest rates. When real interest rates are positive, gold is flat to down. It has to make up for those flat to down years in order to generate this 4.5% annual gain over the last 50 years. It has to create that in the years when real rates are negative. And so it generates outsized returns when real rates are negative. That's what the chart down there says. The chart, by the way, or the table, is not corrected for inflation, and my 4.5% a year is corrected for inflation. That's why they're different. But what it's pointing to is that when real rates are high, gold slides. When real rates are low, gold gains. And there's nothing but negative real interest rates ahead. So if you take anything home, if there's one thing to focus on when you're thinking about gold these days, that is what it is. That is the most important message. Gold gains when real rates are negative, and given that countries around the world are sort of racing their currencies to the bottom to gain an edge in trade as trade contracts. There's not as much out there. They want to attract the trade that they can. An easy way to do that is with a lower currency. So currencies are going down. Central banks around the world are cutting rates. To the purpose of that, you can have lots of discussion about, is it to gain an edge? Is it to encourage growth? Is it to prop up stock markets? Is it to make debts more manageable? Is it all of the above? Probably. At the end of the day, doesn't matter the rationale. What matters is that they're doing it. So central banks around the world are cutting rates. That is, of course, pulling rates farther into negative terrain. And then there's the fact that debt loads are so big that any appreciable increase in interest rates would be very difficult for governments and corporations to manage. So it is safe to say that the high real rates that are the only thing that cause gold to lose ground are not ahead. Instead, negative rates are our new reality, and they always push gold higher. So that is the fundamental basis. The thing, of course, that has changed since we were last here in September is that or even more in that environment. Mixed in with all of that, or a part of all of that, is certainly the safe haven argument. If you look up things like how frequently, or common search terms on Google, there's a strong correlation between how much people are searching the word recession or worried about recession and when recessions actually happen. That's just one indicator that the safe haven trade is increasing. The recession risk is rising. People are worried about it. Whether or not it's going to happen is another question, and I do not have an answer to that question. It's possible that the Federal Reserve did enough cutting early enough to prevent a sharp recession this time. It's also possible that they didn't. I do not have a crystal ball, unfortunately. But what does matter is that valuations are high and recession risk is real. And that means that increasingly money is looking for security. The safe haven trade has always been to buy bonds for yield and for countercyclical performance, except that that's not what bonds provide right now. They don't provide yield because of negative interest rates. A quarter of investment grade bonds carry negative rates. That screws up the entire safe haven situation. So there's these big pools of low risk money that have always relied on that trade that can't. And so they need to go somewhere else. And so they are increasingly interested in gold. I think I showed this exact chart in September. I love this chart. That's why I'm showing it again. I love things that have very strong correlations. And the correlation here is the market value of global negative yielding bonds and gold. And they are right side by side. So as we have more and more negative yielding bonds, as this bond market gets more and more screwed up, gold gains right alongside. And so that is the safe haven argument being increasingly focused on gold this time versus previous iterations. I also want to underline that central banks are buying a lot of gold, and that does matter. Central bank buying isn't something that causes the gold price to spike on any particular day or week, but it does create a really nice foundational strength for the market. And so you can see, I mean, this chart goes back to 2000. There were those years in the early 2000s when we had globalization and so much growth in China that central banks were like, this is easy, we don't need to have safe havens, and so they were selling gold, and then they were like, oh, the financial crisis, that's not so good, we should buy gold again. And that has sustained now since 2008. Central banks have been buying, and if the bar for 2019, which of course isn't complete yet, but were it on there, it would be larger than any of the others. Like, the rate of increase is only growing. So central banks are certainly contributing to strength in gold, which is great. And then we get to this argument where the price of gold has done well. It certainly did well this summer and into the early fall. But gold stocks haven't done that well. That in itself is an oversimplification. There are a lot of gold stocks that have done very well. The gold stocks that investors turn to first have done darn well, right? So those are the large mining companies, the royalty companies, they have done very well. But in general, gold stocks haven't done well. That means that the gold sector really stands out as relative opportunity amidst this broad stock market that just keeps marching higher. The trade war is far from resolved. This phase one trade deal, the phase one trade deal is really about China really needs agricultural products. They need pork like you wouldn't believe. They need soybeans like you wouldn't believe. The Asian swine flu is a big factor here. So they need a trade deal to get pork on the tables. Trump needs a trade deal to announce a trade deal. Have they even discussed the issues that are at the core of this battle? No, they're not. Nobody is mentioning anything about support for strategic industries or intellectual property, protection of privacy. These are the things that the trade war is actually about. This is why Trump started this trade war. For him to roll back all of the tariffs would mean him giving up the leverage that he has established without achieving the goals that he set out for. So I don't think any large-scale trade deal is on the table at all right now. A small deal for sure, and that will give the broad stock market. I describe market investors these days as being fairly black and white, fairly binary. They want the stock market to continue, the bull market to continue. So any news that comes out has to go into one of two baskets. Is it good for the stock market or is it bad for the stock market? And for sure, any kind of trade deal is good for the stock market if you had to only put it in one of two baskets. And so news of a trade deal has been helping the stock market to continue to rise. Is a phase one trade deal really going to have that much impact on the global economy? No, not really. The impacts from the trade war are increasingly showing up. I would say US tech firms are going to be the canary in the coal mine. We see the impacts already in some places, but US tech firms are starting to lose their largest customer, which is China. If China has to pay a bunch of tariffs to buy things, then they're not going to. And so they are sourcing their supplies elsewhere. The tech firms that have led the US bull market higher are going to start showing their losses as in the coming quarters. These are all part of the recession risk. These are all part of the reason why investors are increasingly going to look for value, and value is hard to find except for in a few spaces, and the gold miners are certainly one of them. This just is a demonstration of what I said at the beginning of that rant, which is that the metal has performed and the miners have not yet performed very well. You can see here the price of gold in gold. You can see a gold ETF in blue, so you've had $6 billion of inflow into a gold ETF, so investors are putting money into physical. That's how it always starts. But the black line shows that over the year we've actually had $2 billion of outflow from the GDX, from the gold miners index, and so investors are still very much favoring physical over miners, but that will change as this relative opportunity continues to progress, as the gold price moves back into some seasonal strength. I think the momentum only has to go a little bit farther before we get the tipping point where money starts flowing more into the stocks and not just into the metal. And I do want to emphasize that the current slide in the price of gold is not very surprising. For one, we had an 18% gain in a pretty short period of time. Things like that usually correct to some extent. Secondly, gold always does poorly in October. Sure, this time it was a little bit like late October, early November, but it's still the right time frame for it to just be a seasonal move. And gold's losses in October almost always have the same effect. September is always a really great month for gold. So in contrast, for gold to slide in October feels it provokes a lot of anxiety. So then two things happen. Investors who have made money in gold stocks in a few strong months, which is what we had, July, August, September, say, uh-oh, I better take money off the table. And that's a smart move. And then there's the anxiety of, how big is this slide going to be? Do I need to exit? So a bunch of selling starts to happen. And when gold investors see selling, especially before the bull market is really, truly established, they get anxious themselves and can pile in. Then you add tax loss selling in on top of that, and it all amplifies. And so we get this kind of pattern where stocks always slide into the end of the year and then do pretty darn well from the middle of December through to the middle of February. So what's the takeaway from that? First of all, don't panic right now. The current gold correction is a pretty predictable part of the pattern. The micro pattern, the fact that we had such a strong gain and it will correct from that, and the bigger picture pattern that this is what seasonality does. So if you have stocks that you want to exit, I would suggest not selling them now, but waiting until mid-February because they will probably be worth more then. That's just the way the pattern works. And the other conclusion from that is that you do have the option to play this seasonality if you want. It's very likely that stocks will be worth more in mid-February than they are worth now or a few weeks from now. So if you like to book 20% gains, if you're more of a trader, then that's absolutely an opportunity that's on the table right now. It's a pretty reliable opportunity to add 20% to your portfolio by investing now and selling in a few months. This is an example. I'll just go through these quickly. This is an example of how little allocation generalist investors still have into gold stocks. So the gray line on the bottom is gold assets under management as a percentage of the market cap of the S&P. So it's gold exposure as a percentage of an average portfolio. It would have to almost triple to get back to the level of gold exposure that investors had in the last bull market. And of course, when generalist money comes in, it's not a large absolute amount of money, but it is a large amount of money relative to the size of the gold sector, which is really tiny. And so those generalist dollars rotating in, even just giving themselves 1.5% allocation in their portfolios, creates this outsized impact in our space. And so the conclusion here is certainly that the fundamental forces propelling gold are as strong as they've ever been. We may be in a month right now that isn't as exciting and where we're having a seasonal correction, but the fundamental forces are absolutely aligned in favor of gold. And yet we are at this position where investor interest in gold equities is only just started. We've had some investor interest in equities for sure, but a little bit more gold market and that interest will do what it always does, which is create this gold bull market pattern. It's a reliable pattern. Yes, our sideways stint here has been more drawn out and, to be honest, frustrating than usual, but the end part of the pattern is always what it is, which is this spike that lasts 9 months to a year and prices at least double, if not more. And so that is yet to come. So it means the upside is still ahead. The fundamentals are very strong. The current situation is seasonality. What I'm saying is I am not panicking. I am very confident in where we're going, even if the current moment isn't as interesting and exciting as I want it to be, right? So that's sort of the summary of where I am right now. These are the publications that I have. If you have any questions about those publications, please find me and ask. I publish a weekly newsletter about what I'm buying and selling. I publish a monthly newsletter for more generalist investors who'd like to be introduced to the space, and I have a service about financing opportunities. And with that, I'm even early. That doesn't mean you get extra time, Scott, but I know you'll take it if I were to give it. I would like to ask Scott of EMX to come.